Okay, let's dive in. You've brought us some really interesting sources today, and they definitely point towards, well, a massive shift happening in the global real estate market.
That's right.
I mean, for centuries, this asset class, it's been slow, pretty illiquid, and let's face it, pretty exclusive.
Precisely. Yeah, it was
Yeah.
really for people with significant capital,
Mm,
and the patience to deal with these complex, often really cumbersome transactions.
yeah,
High barriers to entry, all that tedious due diligence, and just that basic problem of not being able to sell, say, just a piece of a building.
right.
It meant capital got locked up.
Mm,
It accumulated wealth, sure,
yeah.
but it was hardly a dynamic investment vehicle.
Right. It's like you said, trying to trade a small piece of a famous painting. It just wasn't designed for that kind of easy division or transfer.
Exactly.
But these sources you've shared, they suggest technology and some very strategic partnerships are finally pushing back against that old way of doing things.
Absolutely. Technology is giving us the tools, the key tools, and then you have these vital collaborations between different jurisdictions providing the legal and regulatory runways needed for these innovations to actually work.
And the specific focus you've brought for this deep dive is what the sources call the Dubai-Swiss nexus. So our mission today is to use your sources to really explore how this specific link up is pioneering real estate tokenization and this thing called SPV securitization. We want to pull out the key insights for you, the listener, to understand what it all means for the future of investing in real estate and, well, who gets to participate.
That's the plan, to really dig into this material and show how this shift is making real estate more investable, more transparent, and potentially much more accessible than it's ever been.
Okay, so let's first really nail down that traditional picture. Beyond just the high cost, what made getting in or out of real estate so difficult compared to maybe buying stocks?
Well, just think about the whole process, right?
Yeah.
Buying meant long negotiations, mountains of paperwork, legal transfers of physical deeds,
Yeah.
and settlement times that could seriously drag on for months.
Yeah.
And if you needed cash, you couldn't just sell, I don't know, 5% of your office building.
Right.
You had to sell the whole thing or maybe borrow against it. That lack of fungibility, the inability to easily break it down into identical tradable units, that's what made it inherently illiquid.
Got it. So a big store of value, definitely, but not great if you needed flexibility or wanted to invest, smaller, more targeted amounts.
Exactly.
Okay, so if that's the old way, what's the big disruptive force shaking things up now?
That really comes down to tokenization.
Mm-hmm.
And it's powered by blockchain technology.
Okay.
At its heart, it's about fractionalization. So
Yeah.
taking a single valuable asset like a building, an apartment block, whatever,
Yeah.
and representing its ownership as potentially thousands, maybe even millions
Right.
of individual digital units. We call these tokens.
So fractionalization is just chopping it up digitally.
Yeah, essentially. But the key thing is what that token represents. It's not just some digital IOU. It's a verifiable, immutable ownership stake that's recorded on a blockchain.
Right, that distributed ledger thing.
Exactly, which is transparent and tamper-proof. So this digital representation kind of frees real estate from its physical chains, you could say. It turns this single, indivisible asset into lots of easily tradable units.
And this is where it gets really interesting, isn't it? The sources really highlight some immediate, concrete changes, like fractional ownership suddenly becoming accessible. You don't need millions to buy a luxury villa. Maybe you can own a token that represents just a small slice of it.
That's the idea. And that obviously dramatically lowers the investment thresholds. But critically, it also opens the door to a potentially vibrant secondary market.
Ah, so you can trade these tokens later.
Precisely. One of your sources has that great analogy. Imagine trading a share of a luxury villa in Dubai as easily as you trade shares of a publicly listed company. That ability to buy and sell small pieces of real estate easily, that's the core promise tokenization starts to deliver on.
But, okay, hang on. You can't just, scan a building deed onto a blockchain and call it a security, can you? There must be some legal structure needed. This is where the SPV comes in, the special purpose vehicle.
That's exactly right. Yeah, tokenization is the tech layer, the digital part, but it absolutely needs a solid legal framework underneath it.
Yeah.
And the SPV, typically it's a separate legal entity, like a company, set up for just one reason.
Yeah.
To legally own the underlying real estate asset or maybe a portfolio of assets.
And why is setting up this separate company so important for tokenization? What does it actually do?
It serves several really critical functions.
Uh-huh.
First, It ring-fences the asset.
Ring fences.
Yeah, it isolates the property from any other debts or liabilities the original developer or owner might have, so that protects the investors. Second, it centralizes the legal ownership and the management of the actual physical property within that single entity. And third, and this is crucial for what we're talking about, it acts as the legal wrapper for the tokens themselves.
Ah, okay. So if I buy a token as an investor, I'm not technically buying like a square foot of the actual building.
Correct. You own tokens, and those tokens represent an interest. Often it's equity, sometimes debt in the SPV, and it's the SPD that holds the legal title to the physical property.
That feels like a really key point from these sources. The power isn't just the token itself. It's the token representing ownership of the company that owns the asset.
Precisely. This clever legal setup, as the source puts it, bypasses the complexities of direct real estate conveyancing for every fractional trade.
Right. You don't need to go to the land registry every time someone sells a token.
Exactly. And that's what makes the tokens potentially highly liquid and easily transferable. It transforms these, traditionally static assets into dynamic, highly bankable securities.
Okay, so we've got the tech tokenization and the legal structure, the SPV. Now, your sources really emphasize that where you actually implement all this matters a lot. Why is the jurisdiction, the country or region, so critical for this digital shift?
Because legal and regulatory environments are, well, they're not all the same. Financial innovation, especially when it involves new kinds of digital assets and securities, needs a landscape that isn't just okay with it, but actively supports it and provides really clear rules.
Right.
And this is where this Dubai-Swiss nexus idea comes up in your sources as a particularly compelling model, maybe even a blueprint for how to do this right.
Okay, let's break that down. Switzerland first. It
Yeah.
obviously has this long-standing reputation, financial stability, strong legal system.
Indeed. Switzerland brings centuries of financial history together with a really sophisticated legal framework. And crucially for tokenization, they've been quite progressive. They enacted the Distributed Ledger Technology Act, the DLT Act.
Right, you mentioned that.
Yeah, and it provides comprehensive legal certainty for these tokenized securities. It basically gives them the same legal standing as traditional securities. That clarity is absolutely vital if you want to attract serious institutional money.
Okay.
Combine that with strict oversight from FINMA, that's their financial market authority, ensuring strong anti-money laundering and know your customer compliance. Well, Switzerland becomes ideally suited for structuring the SPVs and issuing the security tokens. It brings that essential legal credibility and investor protection.
Okay, so Switzerland provides the robust, credible structuring part. Now let's look at Dubai. It feels like it's just exploded onto the scene as a global hub for finance and tech recently.
Dubai has very strategically positioned itself as a leading innovation center, specifically focusing on bridging real estate and digital assets. You've got regulatory bodies like the DIFC, the Dubai International Financial Center, the DFSA, which regulates it, and now VAR, the Virtual Assets Regulatory Authority.
Wow. Okay.
And they've actively created bespoke frameworks. These are rules designed specifically for digital assets and the companies that deal with them, the VASPs,
VVAs.
virtual asset service providers, think exchanges, wallet providers, etc.
Got it.
Add to that its strategic location, a very attractive tax environment, including zero personal income tax and often zero capital gains tax on real estate under certain conditions, and you've got an environment that's incredibly welcoming for these tokenization projects. Plus, its real estate market has seen phenomenal growth, really fueled by a huge influx of global talent and capital.
So they offer both the specific digital asset regulations and a booming market.
Exactly.
Yeah.
Dubai's vision for becoming a leading digital economy isn't just talk. It's backed up by concrete regulatory action and a very pro-business environment, especially in their free zones like DIFC or DMCC. This makes it almost irresistible as the place to locate the underlying asset itself. You leverage that strong market growth and the attractive landscape for investors.
So how does putting these two together, Switzerland and Dubai, the nexus, create what the sources call that strategic symbiosis? What's the magic?
It's really a powerful combination. You use Switzerland's precision and credibility for the complex legal and financial structuring, setting up those robust SPVs under the DLT Act, which gives them immediate legitimacy.
Right.
And you pair that financial engineering with Dubai's dynamic, growing real estate market and its forward-thinking, innovation-friendly regulation. It creates this kind of optimal pathway for launching and scaling these tokenized real estate ventures so they have global appeal.
So you get the best of both worlds, basically.
Precisely. You could, for example, set up the SPV in Switzerland, benefiting from its clear DLT laws and reputation for stability, while the actual physical building is located in Dubai, capitalizing on its market growth, regulatory support, and, frankly, investor appetite. The tokens then represent interest in that Swiss SPV, and they can potentially be traded on regulated exchanges anywhere. That's the synergy.
Okay, this is starting to make a lot of sense. So stepping back a bit, what does this Dubai Swiss model and this whole trend of tokenization highlighted in your sources actually unlock for you, the listener? Why should someone listening care about all this?
Well, fundamentally, it changes the game for real estate as an investment. Firstly, think about that unprecedented liquidity we talked about earlier. Breaking down assets into tokens, enabling secondary markets, it means your capital isn't necessarily locked up for years and years. The nexus structure helps here. Switzerland's DLT Act clarifies the rules for secondary trading. Dubai's status as a global hub brings in more potential buyers, increasing market depth, and the potential for using digital payment rails could mean much faster settlement times compared to traditional deals.
So what that means for you listening is potentially much easier entry and easier exit. Flexibility that traditional real estate just doesn't usually offer.
Exactly. Then there's global investor access, those huge investment minimums and, geographical barriers. They start to really shrink or even disappear.
Right.
Dubai's position as this global crossroads attracts capital from everywhere, further expanding the potential buyer pool for these tokenized assets.
So you're not just limited to investing in your local neighborhood anymore. You could potentially access high-growth opportunities in dynamic markets like Dubai, maybe starting with much smaller amounts of money from almost anywhere in the world. It really opens up a global portfolio possibility.
Precisely. And it's not just investors who benefit. Developers see huge advantages through enhanced capital formation. It can be faster, potentially more cost-effective than just relying on traditional bank loans.
How so?
Your sources mentioned some innovative models. Things like crowd-funded development using security token offerings, STOs, basically bypassing banks sometimes, or fractionalized debt, which can attract a wider range of lenders. Even pre-sale tokenization to get liquidity earlier in the project, or tokenizing existing portfolios to free up capital. There's even talk of automating parts of project finance using smart contracts.
So that potentially fuels more development, creating a wider variety of investment opportunities for people like you.
Correct. Transparency and trust also get a significant boost. Because the ownership records and transaction history are on that immutable blockchain, it really cuts down on information asymmetry, where one party knows more than the other and reduces the risk of fraud.
And the regulators are involved.
Yes, both Switzerland and Dubai have built regulatory oversight into this. FINMA in Switzerland, DFSA, and VAR in Dubai, they're implementing robust anti-money laundering and know-your-customer rules and licensing these virtual asset service providers we mentioned. That adds a layer of compliance and investor protection.
So for you, the listener, that should mean greater confidence, greater security in knowing the investment is legitimate and your ownership is verifiable.
Hopefully, yes. And all this leads towards what the sources call the democratization of wealth. By drastically lowering those entry barriers, real estate ownership, or at least participation in its economic benefits, becomes potentially accessible to a much wider group of people globally.
It kind of empowers individuals who are maybe priced out before to participate in what's historically been a major way to build wealth.
That's the potential, yes.
And let's not forget the regulatory and tax efficiencies that this specific nexus offers. You mentioned setting up the SPV in Switzerland benefits from the DLT Act's legal certainty and compliance framework, while having the asset in the Dubai Free Zone can offer those attractive tax incentives like potentially zero income and capital gains tax under specific conditions as flagged in the FAQs.
Right. And those efficiencies can directly boost your net returns as an investor. It's a tangible benefit.
The sources also highlight that this opens up investment in emerging asset classes beyond just apartments and houses.
Yeah, think about commercial real estate, logistics centers, warehouses, huge growth there. Data centers, another big one. Hospitality, hotels, and also green or sustainable developments.
Why are those particularly suited for this?
Well, many offer steady yields. They align with current market trends like e-commerce driving logistics demand or the huge need for data centers. And the ESG focus, environmental, social, governance, is massive now. Tokenization fits well here.
So this gives you a way to diversify your portfolio into these niche or high-growth sectors that might have been hard for individuals to access directly before. And you can potentially align investments with things like sustainability goals.
Exactly. We've touched on investor protection and AML already, but it's worth just quickly reiterating that double layer of regulation from both Swiss and Dubai authorities. It's designed to provide a strong safety net, something question 4 in the FAQs goes into.
Right. And there was even an interesting angle on immigration residency.
Yes, specifically regarding Dubai's Golden Visa program, which can be linked to real estate investment. Now, owning tokens isn't the same as directly owning the physical property for residency purposes.
Okay.
But the ease of investing significant capital into Dubai real estate via tokenization, potentially structured through a Swiss entity, helps establish that required financial presence. This can support eligibility, particularly for high net worth individuals looking at residency.
Interesting. So for some listeners, this could actually link their investment strategy with broader lifestyle or even relocation goals.
Potentially, yes.
And for those who really like to get into the details, the sources stress the need for new ways of evaluating opportunities in this tokenized space. It's not just the old real estate metrics anymore.
No, you need to look beyond just cap rates and square footage. The list in the source includes traditional KPIs, sure, but also understanding the tokenomics, the economic design of the token itself, the incentives,
Okay.
the specific SPV structure and its governance, the details of regulatory compliance and any audits, the liquidity potential in the secondary market, even underlying blockchain metrics, potential integration with DeFi, decentralized finance, and of course the exit strategy.
Wow. Okay. So it gives you a much more sophisticated toolkit for analyzing these kinds of investments if you're willing to learn it.
It requires a broader perspective, definitely.
The sources also mentioned this isn't just for small investors. Institutional use is happening too.
Oh, absolutely. Sovereign wealth funds, large institutions, they're looking at this framework for more agile diversification. It allows them to get very specific, granular exposure to certain assets or markets, enjoy potentially better liquidity than direct ownership, maybe reduce transaction costs, expand their global reach easily, and even mitigate certain risks through the SPV structure.
Seeing the big players move in definitely speaks volumes about the perceived legitimacy and the potential scale of this whole trend.
It does lend it credibility, yes.
Zooming out even further, your sources touch on potential geopolitical implications. This isn't just about buying and selling bits of buildings.
No, it could have wider effects. Think about potential decentralization of capital, maybe shifting influence away from just the traditional financial centers, possibly less reliance on old-school banking systems for cross-border deals. You're seeing the rise of these new digital asset hubs like Switzerland and Dubai are aiming to be. It could spur more cross-border investment generally, and maybe even lead to regulatory competition as countries try to attract this kind of innovation.
So this is potentially reshaping parts of the global financial architecture, not just real estate investment.
That's the broader context, yes. And finally, there's the growing influence of ESG. Investor demand plus regulatory nudges are pushing more capital towards sustainable projects.
Like green buildings.
Exactly. Green building certifications, projects with renewable energy components, social impact initiatives, and blockchain itself can offer better transparency for actually verifying these ESG claims, proving a building really is energy efficient, for example.
So another opportunity for you, the listener, invest in line with your values, potentially capture a green premium if those assets command higher valuations.
That's certainly part of the attraction for many.
Of course, it's probably not all smooth sailing. The path to making this mainstream, I assume there are challenges. Your sources must mention some.
Oh, absolutely. It's still evolving. Key challenges include achieving better regulatory harmonization across different countries, not just between Dubai and Switzerland, but globally. Also, developing really robust, liquid, and user-friendly secondary trading platforms is crucial. And there's still a big need for ongoing education for investors, but also for traditional financial institutions to really understand, trust, and integrate this new paradigm.
Right. It's definitely still a journey then, but the overall direction seems pretty clear from the material you've shared.
Absolutely. The source's final thought really sums it up well. This isn't just some small tweak. It feels like a revolutionary leap forward. It's poised to fundamentally alter how we think about, how we transact, and how we get value from real estate globally.
Okay, so to kind of wrap this deep dive based on your sources, the big message seems to be that real estate, which for so long was illiquid, very localized, is transforming. It's becoming potentially much more liquid, globally accessible.
Mm-hmm.
And this is happening mainly through this powerful mix of tokenization technology and clever SPV legal structures, with this Dubai-Swiss nexus serving as a really strong working example of how it can be done.
It's really about taking real estate and turning it into a truly bankable security, something that fits into a modern, digital, global investment portfolio.
It completely reframes how you might think about using property to build wealth.
It certainly does. It opens up a lot of new possibilities.
So a final thought for you, our listener, based on this exploration: how might this transformation reshape your own perspective on real estate as an asset class? And maybe what specific aspect of tokenized real estate might you want to explore further as this whole space continues to evolve? Something to think about.
Definitely food for thought.
Thank you so much for walking us through that. Really fascinating stuff.
My pleasure.